Hi, thank you for tuning in. Welcome to the It's Your Money and It's Your Estate workshop series brought to you by our nonprofit organization, Financial and Estate Literacy. Our mission is to empower people like you to take control of their finances, their estate, and charitable giving decisions. For the past 25 years, our founder, Peter Coate, and our entire team have been providing these free, unbiased, and accessible 6 weeks programs all over Orange County, California to help you make informed choices that align with your unique needs and values. Now let's start the program. This webinar is the 5th session of the It's Your Estate program. The topic is Charitable Opportunities. Our guest speaker is Don Vivrette. Our moderator is Peter Coate. And this webinar is brought to you by In Defense of Animals. Enjoy the workshop.
Don, why don't you come on board? There he is.
Hello. Hello.
He looks so wise.
I was going to say, look anemic.
Now, Don is he's on our board of financial estate literacy. He has been an invaluable volunteer throughout our programming. He actually is the one who initiated and took the torch to start these live webinars. He has retired after a few years of that, which was and Eugene's taken over. But thank you, Don, for doing all that, because it's really been helpful. So I don't know if we need to put your Ask First up there, or if you want to just talk about a little bit about I understand you're a retired CPA, and but you're also what we would call a philanthropic advisor, and tell us a little bit about that.
So, over the years of doing different things, and Trevor mentioned, how do you grow up? What do you do? And involvement with a church or with something else or something, I guess. And I think that's sort of my parents' focus along the way was, is it time, treasure, or talent that you have to give? And theirs was a lot of time. They had talent and other things, but we're very actively involved in certainly in church groups and other things. And so it was always important from the family standpoint. And it, excuse me, I think sort of became a basis of giving back and doing something with it. And so that got us involved with it. Over the years, then that expanded. I had a company that I had for a number of years and dealt with that, but we had bought a building and said, we're going to get rid of the building. Well, you're going to pay a horrible capital gains tax if you do that. And so ironically ran into Pete. We were going to visit a friend of ours and discussed a charitable remainder trust. And so it became, since I'm a numbers guy and fixated on it, really researched what all do these things mean and why would I do that and what was going on with it. And that was sort of became the basis of a lot of the things we talk about in here. But looking at what are the opportunities, and to me, there's nothing wrong with saying I'm going to give something, but I get something back. And so if that's a tax deduction, and we haven't talked about the slides that I have in here, we're going to skip through a few of them because Eugene did his and Trevor was talking about some of the ones he's talking about are slides that we're going to go through here at the beginning, just because I had put them in not knowing, I did this live a week ago and doing it this afternoon also in Laguna. But, sort of looking at where we're going. So let me share screen with you, and I'll share screen too. Boop. I'm assuming that just brought that up. Yep, there we go. Okay. So in terms of where we're going, this is basically how do you give and still give back? Because as I say, that really isn't a bad thing in terms of what we're doing. Email address is there. It'll be again at the end. You can download the handout material. You see that, and Eugene already mentioned that and showed you how. Ask first form. Yes, I have a master's degree. I have a CPA for a lot of years. Yesterday was my 75th birthday. And a lot of people look at it and go, why do I still have an active license? And I do it because it's interesting. You have to continuing ed and all of that's very important to me. So going through and doing that, I have an active license. If you log into the state and look at it, it's going to be amazingly boring because most of my time has not been really spent as a CPA doing taxes and doing all that. It's being involved in understanding the numbers and seeing what all that means. Then over the years, no, I don't practice legal. Yes, I only deal with the clients in terms of who I talk to. I'm in an odd situation because of giving and getting back. I do philanthropic advising to people and help people run the numbers. I don't want to be paid for it. So what I say to people is, because it's important to have a value and people see the value, I'm going to give you the information you want and be happy to help you all you want with it. And at the end of it, I'm going to tell you to write a check to a charity. And I don't care who it is because it's important to you, not to me. And I'm not going to make you prove it either. But I don't want to be paid. I want you to give money to charity. And I'm agnostic in charity. I don't, this is what you have to give to. No, I don't, it's what's important to you, not important to me. So I'm going to probably skip a couple of slides here because Eugene just went through this. Here's how you get in. Here's how you get to the website. Here's the information. Ironically, this is pretty much what he just did. And here's where all the information you can get out of this. Where I want to go is to this one. And it goes to Trevor's point a few minutes ago, in terms of looking at the government doesn't do everything that needs to be done. And this is in 2023. Yes. So last year, there was $500 billion given by people, not companies, not the government. This is how much money was given by us as individuals. Now, 67% of that was given as individuals, if you look at it from the standpoint of just normal giving. But if you then add this 8%, which are those of us who have died, who tend not to attend the seminars, but you got 75% of the people, of the money given, so 374, over 400 and something billion dollars is given that year to charity by individuals. And that's our being involved in terms of what's going on. It's, foundations are virtually nothing in here by comparison, but the individuals are giving a tremendous amount of money, and that's very important. But one of the other things from my standpoint is, I can do this. Yes. Where do we give? As Trevor mentioned a few of them, if you look at religion's almost 25%, going to church, giving money, tithing, whatever term you want to use for it, human services, education, foundations, other things all the way down the line. There's a whole wealth of different organizations you can give to and you deal with. And if you look at how many there are, according to the IRS in 2023, there were 1.3 million charities, 501c3s, as Trevor mentioned, in the United States. 75% of them have a budget of less than $100,000. If you want to give money and have an impact on an individual organization, think of the impact you have however much you give, it's certainly going to affect one of those smaller nonprofits, as opposed to someone who's in a $5 billion, whatever, huge charities. It doesn't mean you don't give to them, but it means you want impact and to see what's going on. I think somebody made a comment that I live in Laguna Beach and there's 200 nonprofits in Laguna Beach. Really? We have that many people here? Yes. But yet there are things that people are involved with, but a lot of them are very small and really, really need money in terms of being able to function and do what they do. I'm going to keep drinking water through this. Trevor made a comment also in terms of living longer. It's an interesting statistic that you do live longer if you give. It seems to mellow you out and chill you, as Trevor was saying. But I'll touch on it a bit when we get to a charitable gift annuity and some of the interesting issues they're facing because of people living longer when they give money to them. So let's go through a thing that I started doing was, let's figure out what issues we want to solve. Why are we talking about this? Well, one is you may have a desire to give back in some form. Again, time, treasure, or talent. What is it you're giving? And it may be that you have money that you can give, and maybe it's now, maybe it's later. But that's important just to have that feeling of want to give back in some way. It could be that you're doing this from an income tax standpoint. You can avoid some of the taxes. It's not evasion, that's illegal. It's avoidance or deferral of a tax. We'll talk about capital gains in a moment, but just normal tax deduction. If you give money to charity and you're itemizing your exemptions, and we'll talk about that in a minute in terms of what that means, you can use the money you give today, and if you don't use it all, you can use it over the next 5 years. I just helped my sister go through some her husband died 6 years ago, and they had an agreement that when she passes away, they'd give certain money in a bequest. And I said to her, being the bean counter that I am, your estate's going to get no benefit from that from a tax standpoint. If you give it now, give appreciated stock now, you're going to get a 30% tax deduction, probably for the next 6 years, because you won't use it all, because it's a big deduction she has. And it's like, wait a minute, I could save 30% on my income tax. Yeah, so all you got to do is just give them money. And so then it was about, oh, okay, I think we should talk about that. Okay. Capital gains is a big thing, whether it's a sale of your personal residence or if you have investment property. A lot of the people that we've seen at the various sessions we've been at have rental property they've dealt with before, and they may have done a thing called a 1031 exchange, which I had done with buildings that we've had. And those are great. You can build nice, nest egg sort of thing. But dang it, the last time when you sell that last one, there's a miserable capital gains tax that you may face. Or you may find that it's better to give it to a charity and get money in return. And that's where these are the kinds of issues that we go through and talk about. Estate tax planning today, and the number is going up shortly. It's currently $13.6 million we each have as an exemption. Being married, that means Gene and I have $27 million. That's not going to be a factor for us. It's not going to be nowhere near a factor for us in terms of what's going on. But that doesn't mean you shouldn't be gifting today, giving to people. It doesn't mean, and I'll come back to portability in a minute. At the end of 2025, unless Congress can get their act together and make some decisions and have implementation, the tax planning that went in for whatever the acts we had a few years ago, sunset, they expire in 2025. And the assumption is this $13 million limit is going to drop to probably $5 million. It could be lower. It could be with inflation, it could be 7 million. And that may seem like, that's still way too much more for me to think about. But a couple of things come to mind. One is you can give someone today $18,000. Anybody you want. You can give your kids. You can give each of your kids $18,000. You don't report it to anybody. They don't pay income tax on it. You're reducing your estate effectively. But my wife and I have 2 daughters, 2 son-in-laws, 4 granddaughters across the group. And we could give each of them $18,000. Now, I wouldn't give it to one of the young kids, but if you really stop and look at it, that means we could each give over $250,000. We're not doing it, but if I wanted to reduce the amount, I can give money to my kids at $18,000. For 8 of them, that's $144,000. But we could each write that check. So now you're over $250,000 without having to report it. And that's just a planning tool that you can do that. It'll go up slightly, I think, next year. There's talk of removing it, but right now you can gift it. People will say, can I give money to my children? Help them with a down payment on a house. Yes, you can. Tax-free. If it's over $18,000, which you'd need to be for down payment on a house, you simply fill out a form, 709, and tell the government I'm using it. For instance, in our case, our daughters took over the company that I had. Do you sell it to them? What do you do? And Gene and I talked about it. I said, we're just going to give it to them. So I used part of back then it wasn't 13 million, it was less than that. I used part of my lifetime exemption and gave the company to the kids. Told the IRS. So if I died today, I don't have a 13.6 million. I have several million less than that because I gave the company to the kids. But they pay no taxes on it. It passes to them. They don't have to deal with that. So that's a really important thing. The other one is this thing called portability. If my wife dies today, we have it set that we each get all the money. She won't use any of her 13 million exemption. I can request portability on a 706 form that says, I want her exemption because that way, when I die, we have both of our money. We'd have the 27 million. But a really important thing is going to happen in 2026 after the estate drops. That exemption, if I have portability, I would get her 13.6 million and mine may drop to 5, but I will then have 18 because I'll have her 13.6. It's a very important thing. If you've had If your spouse has passed away in the last 5 years, you should request portability now. It'll cost you something to have a 706 filled out, but that's going to be really important if the estate tax drops.
And you're also saying that it'd be a good idea if your spouse were to die to do it in the next year. No, I'm kidding. I was joking. That was a bad joke.
You got 5 years to get the 706. Well, I think
No, I meant because of the exclusion is going to go down.
I have this odd feeling that there's going to be a lot of people that are going to die at the end of 2025. Oh, gee, grandma's really getting really old. Let's unplug the ventilator.
Yeah,
I'm sorry, I'm a cynical person, but
there's going to be. I just want to make a point. Like, there's going to be a lot of chatter and talk about this, especially if there's no new tax plans with the new administration.
Right.
But I caution people, do not get talked into or scared into changing anything until the ink is dry, or until until we know for sure, because it's a tactic that a lot of unscrupulous estate planning attorneys, financial advisors, they use these fear tactics like, oh, it's going to go down, you're going to have to get, and then they complicate your estate plan and this and that unnecessarily. So it's good to know this stuff, but you still don't want to just jump ahead because you think something's going to happen.
What if maybe possibly something occurs? Well, yeah, okay, there's way too many ifs there.
Yeah.
And the other part of that goes to the cash flow issue. Do I have cash flow today? Well, I think Berkshire Hathaway stock is a wonderful investment. It's a lousy cash flow investment because they don't pay dividends. I mean, Buffett does not pay dividends. He reinvests, cumulative, all the growth things that he talks about. But that means if you need cash from that, you have to sell it. And if you sell it, you pay capital gains. Where there may be an investment you could do, put that into a charitable gift annuity or something else we'll talk about, and you're going to get money for the rest of your life and have to pay no capital gains on it. And that's where the cash flow for today, tomorrow, and what do you want to do with your beneficiaries in terms of what's going on. There's also a thing, being the bean counter that I am, money today to me is more, money that I have today is more important to me than what I might have in 5 years. Planning, that's good. But for instance, when we set up the trust that we did, we took more money now and less money later, because having now been retired for 10 years or so, we're doing less travel, we're doing less other things. We happen to have good insurance, so the medical bills that we've had for the last so many months are all covered because of the insurance from that standpoint. But it looked at it and said, really, what's the planning part of that? And so that's part of what we wound up being able to do. Investments then become, and go back to Berkshire Hathaway. This may be a great stock or something else and growing, but it may not pay any dividends. The volatility of the market may make you nauseous as you go along because of what's going on with it. And some of these things you put in the money and you earn a flat amount for the rest of your life. You don't care what the market does. But it's how do you rebalance things and where do you deal with these? And then you come to the retirement accounts, which we talked about last week. That all comes out as ordinary income. And what's that going to do to you? So all of those are issues. And then ultimately, Trevor made the comment, what passes on to your heirs? Do your kids need all this money? What's going to happen when they get it? And what happens if you have a special needs child or family member? How do you set that up? And how do you fund those as the ability to set up a trust to take care of the kids in the future? And there's big issues in terms of how they receive money versus the government benefits that they may get if they're in special needs. And so those are very critical, and we'll touch on some of those as we go through. So it's not that I'm obsessed with charitable tax deductions, but on the other hand, I'm very willing to say, let's see if we can get some of these. So if you, just to set the tone for this, if you give money to charity today and you get nothing back other than a nice letter that thanks you very much, you get an immediate tax deduction of that on your income tax if you itemize your deduction. So we'll talk about that. Okay. So you get 100%. If I give $1,000, I'm going to get $1,000 deduction. If, however, you get something back, you give $10,000, but I'm going to get money in the future, then you only get the net amount of that because that's what you're getting back. You gave to charity, but you get something back. So you get the net value of that. If you do that after you die as a bequest, then that becomes a part of your estate tax deduction. Now, currently, again, 13 million each. You got to have a really good size estate to start having tax exemptions or deductions rather on your estate. But that's happened. It's the same rules as we had just had, but that's against your estate tax. Income tax deductions come against a thing called AGI, or adjusted gross income. And I'm going to show you a picture of this in a minute, because everyone goes, how the heck do I know what an adjusted gross income is? Let me just put a note here, and then I'll show you where you can get this thing. If you give money to charity and you get cash, give $5,000 to your church for whatever reason you want to do that. If it's cash, you can deduct 60% of your AGI. If it's an appreciated asset, it's 30% of your AGI. So when I was talking to my sister, she was giving appreciated stock. She would get a reduction of 30% of her adjusted gross income for the total amount of what she gave, because she's not getting a return on it. That's a nice thing to have in terms of what's going on. I'm looking for, oh, there it is over there. Okay. So we're going to talk about, when is something a charitable deduction? What are you doing with it? We've talked about all the income deductions. I'm confusing myself. Oh, I'm sorry. We added a bottom line. It's the current year plus 5 years going forward. So that's how you could go get all of it. So what's AGI? So this is the tax form. Since you can't read this as I hold it up to you, I made copies of it. So this is the top part of the tax form up here. It's last year's form. They haven't issued this year's form yet. So where the heck is adjusted gross income? Down here near the bottom, which you can't see as I'm holding it up, is a thing called adjusted gross income. So in this case, it happens to be on the normal 1040 form. You may have a different form. There's line 11 says this is your adjusted gross income. So whatever that number is, when they talk about AGI, that's what they're talking about. That's the number and it affects a lot of your life. If you itemize your deductions, medical expenses, I think, are in excess of 7% of AGI. So that's where this number really comes into play. And that's what you can measure it against, because to me, it's important to know where that comes from. Now, the reality is, in today's world, most of us, vast majority of us, use a standard deduction, because that's basically $30,000. And if you have $30,000 as a Trevor, are you chasing lunch? What are you doing?
I thought there's a mosquito in.
There's a bug. It just looks a little strange. Trevor's out with the clouds trying to catch something. For all this discussion that I'm having, and I understand it in terms of you get a tax deduction, but if I've got a $30,000 standard deduction, I may not get no tax benefit. You might, and there are ways you could deal with that. But I understand and appreciate the fact that standard deduction is very large today, and you need to be giving a lot of money. And because of the way the taxes are set up in California, with a limit on state and local taxes, the SALT taxes, that's really affecting a lot of people. Certainly affected us in terms of how we can deal with tax deductions. So I just want to let you know where AGI is, because that term comes up along the way. That's where the thing actually is. And again, this whole material is on the website that Eugene was showing you earlier. Okay, let's talk about retirement accounts. There's a thing called income in respect of decedent. Weird little term, very confusing to me at the beginning, but it basically says, if you have an account, let's say I have an IRA or a 401k, and I die, someone's going to inherit that, or a charity does, and it's going to be treated in respect of how the money was put in respect of decedent. If I have a 401k, let's say, or an IRA, I'm getting a tax deduction. My income is reduced because I put money away for retirement. And that's a great thing, except when the money starts coming out, and not a Roth, that's a separate animal. But it means no tax was paid coming in, therefore tax is going to be paid coming out. And that's true if it's inherited, because it's in respect of decedent. You're the one that passed away, and they got the money from it. If you're 73 years old or older, then you have to start taking out what's called a required minimum distribution, RMD. The IRS wants their money back. They let you have a deduction over the years, but they want the money back now because these things have grown a lot. In some cases, this may be the biggest asset that you have. Maybe your house is bigger, depending, but a lot of times an IRA is maybe the biggest asset that you have that will pass to somebody. How much do you have to pay for an IRA? RMD. The RMD is a factor, and this was touched on last week, but I just want to repeat it. How much is in the account on December 31? So last year, here's how much was in your account. What's your age? And there's a factor that gets applied against that. And that tells you how much. So in this case, I'm going to pick on 80-year-olds the whole way through there because my sister's 80. I'm 75, she's 80. Okay. So at 80, the factor is 20.2. If you had $500,000 in the account, 80 factors this, she's required to take out $24,752. That's a required distribution. If she doesn't, there's a miserable tax penalty you're going to pay. It's going to come out as ordinary income. That's enough of a penalty. But at the same time, if you don't take it out, I forget how much it is. I mean, I think it was like 20. It used to be 50% penalty, and I think they reduced it to 25 if you don't take out enough.
It's 25% now after the Secure Act 2.0.
My sister scared the crud out of me one day because we were talking about this, and she goes, "Oh yeah, I take out my RMD. I've been taking out 5% every year because that's what I'm supposed to take out." No, it adjusts every year. And I said, the good news, Nancy, is you've taken out too much because at 80, she's now at basically 5%, which means when she below this age, she didn't have to take that much out. Oh my God, I didn't know that. Well, you know it now because next year you'll have to take out more than 5%. Therefore,
Don, do you get credit if you take out more in 1 year to the next year?
no, it's not cumulative. So if she overpaid in the past, she doesn't get that as an exemption going forward. No, very good point. You don't get that. Now, this is going to be very hard to read. I don't know if you can read it. You can't read it at all. Okay. What I'm looking at is my statement from Schwab, where I had an account. And on page 2 of 8, down here in the bottom corner, it says distributions. And it says, here's your 2024 required minimum distribution. You can look at this thing and say, well, but Don, I'm 74. What's the factor? You don't care because it's right here on your on the statement from your brokerage account. Because someone's holding your money. And every year they should give you a little thing a line item on this thing. This happened to be February statement. So it isn't just once a year. And when if you take out money along the year, it'll tell you how much you've taken out. So it warns you and tells you how much there is. But it's on your financial statement. You can't see mine. I can hold it up to you in class, but I can't hold it in front of a camera. Okay. What does this have to do with charity? Why are you telling us this? Because Secure Act 2.0 and whatever came up with this concept of a qualified charitable distribution and made it a permanent issue. It had been temporarily in and out, but it made it an ongoing thing. A QCD is a way of giving, if you want to give money to charity, if you give money to your church every week, if you give money to the Salvation Army when there's a disaster, or Red Cross when there's a disaster, or something else, you're going to give that money away. You should use your QCD. Because what this does is it reduces your income. So if I have to, and I'll pick on this lady for a bit here, my $24,000 person, that's how much she has to take out. And she's going to pay income tax on that. If she gives X amount of money away to charity, $1,000, it reduces how much that $24,000 is and makes it 23 if she gave 1,000 away. We'll have an example in a minute that she gives away 15,000, but while we're here, it's 100% deductible because it isn't a deduction. It reduces your income. At the end of the year, you're going to get a 1099-R from, in this case, it would be Schwab, whoever's holding your money, your retirement accounts. And it's going to say your required minimum distribution that you took, let's say you did a good job and you took it all out, was, in this case, $24,000. Period. And that's going to be told to the IRS. But if you give money through QCD, you can reduce that $24,000 by whatever you give to charity. So again, what you give to the church every week, what you want to give to whoever the 501c3s are, you give that money to them. What you do is you go to your brokerage account and say, I want to do a QCD. Write a check to the Red Cross for this much money. And normally what they'll do is they'll mail that check to the Red Cross, who has no clue why they just got the money. My suggestion to you is have them write the check to the Red Cross and have them mail the check to you. When you get it, you can't cash it because it's made to Red Cross, but you make a photocopy of it because then when you do your taxes, you have proof that you gave it to charity. And that automatically reduces how much you're going to pay in income tax. You then write a nice note to the Red Cross that said, I'm a really nice person. Here it is. And you mail it off to them and they can cash the check.
Don, I have a question.
Please.
Because I obviously haven't done this before.
You're slightly younger than I am, yes.
Do you also get let's say from the custodian, Schwab,
Yes.
get any sort of, and like, do they send you like a 1099?
R.
Is that what it is? 1099-R
that says this is how much you
reflects the required minimum distribution taken out. But do you get anything that shows that you've done a QCD from that?
It depends on the brokerage firm. Okay. And that's why I make a copy of them. We get them. Schwab did. I think Gene had one from Merrill Lynch, but I've heard from others that they don't get anything. And that's why I say if nothing else, make notes to yourself. Yeah. And that's why I say get it, make a copy of it, and attach it to that note. So you have, here's my proof I did this. And what they'll say is, yes, these checks were written out of your account. In the case of those two brokerage firms. But I can't tell you the others do it. I don't know.
Okay. So basically, just to sort of nail this down. So if you're already giving, let's say just normally regular, not necessarily anything extraordinary.
Right.
And you're taking the required minimum distribution at the
which you have
time, which you may have to. This is sort of a slam dunk. I mean, because it definitely seems like the most tax-wise way to give.
Yes.
As opposed to, let's say, taking the $24,000, putting it in your account, and then using that. Oh, look what that is, an illustration.
Oh, there you go. There's an illustration of this. Good lead in. I like that, Trevor. That was very good. So, I mean, and just using this, again, my 24,752 lady, if she gave $15,000, and that's just a number, just to, here's a pegging of something, gave that to charity, then she's only going to pay income tax on $9,752. If she had an income tax of only 20%, which is a low number when you take state and federal, because it's deductible on both, she's just saved $3,000 by giving a QCD. And incidentally, she paid less income tax, but when you start going through, her Medicare bill didn't go up because she had a higher level of income. And possibly the tax she pays on her Social Security didn't go up either. We were chatting with a friend at some function one day, and she had heard I did this, so we were talking about it. And she goes, every year when I get my RMD, I look at how much all my bills are going up for Medicare and for Social Security and income tax. And then I give money to charity. That doesn't make sense. To Trevor's point, this is right off the top because you still take a standard deduction because this is not a deduction. It's an exclusion. The money doesn't come in. Therefore, it's 100% deductible right now. And let's do sort of where Trevor was going with this thing. So the church, if I give $50 a week, it's a number. That means if I gave every week, that's $2,600. If you take the money out of your RMD and write them a check for $2,600, you had to take out $3,250 to pay 26. This is only 20% tax because at 20%, if you took out $3,250, you're going to pay tax of $650, which gives you $2,600. Right off the top. You don't have to do much. You just say, please give the money. I was talking to somebody at a church group one time, and they went, but the church wants my money every week. Tell you what, if you go to the church and say, listen, and you can do this any time of the year, I'm going to give you block money for this reason. And if they say no, find a new church who'd really love to have your money. They want the money any form they can get. They'd like it any time of the year. Okay. Now, Flip side of that is if you use the QCD, then you save $650 in taxes. And if you want, you can give that also to charity. Or you can keep it because it's your money. But that's what you just saved by that one simple thing that's been done. This is, to me, this is the number one charitable giving thing that everybody should be doing, certainly if you're 73 or older. If you're 70 and a half, you can do it. Okay, you're reducing your taxes. You don't have to take an RMD. And you can pay more than this, just your required minimum distribution. You can pay up to, I think it's $100 and something thousand. And the reason you might want to do that is if you don't want all the money in your retirement account now, you can remove some of it by doing a QCD and reducing the amount in your IRA. So now that may be an issue to help you with your kids on the other side of it.
Well, and isn't there also, so you have like a lot of people, you know, I talk to people like when they come on to their first year having to take an RMD.
Yeah.
They're a little surprised how much income it actually is. I mean, even though it's a low percentage of what it would be. What are some of the, I mean, it seems like some people would like to manage their tax brackets in a sense where sometimes if you take too much income out of your RMD, it may kick you into a
higher level
and then pass a threshold for what, like Medicare
and and potentially Social Security tax.
Yeah, so you might get taxed more. So this is another, I mean, a tactic really to try and manage that a little bit.
Yes.
And also make a gift and do, you know, so that's kind of an interesting part of this whole.
It's a twist that most people don't even know. Well, and to your point, a lot of people are startled when the RMD hits because they may, and God forbid you try to find this one liner on my Schwab statement. I had to go search for it to figure out where it was. And of course, I read all of my financial statements every month, page by page, including all the disclaimers at the end. No, because I know on one of the other, I think on Gene's account, this is like on page 8, not on page 2. And it startles people. And the first year is an interesting one because you don't actually have to take the RMD in your first year. You can roll it into the next year. But that's a problem from a tax standpoint. You avoided it this year, but next year you're going to have 2 of them.
Yeah, you're bunching your income.
Now you're bunching them, and now you got a real big issue in terms of how much you're having to take out. And so this throws a lot of people from a tax planning standpoint.
Yeah. So it's kind of a good idea if you're kind of coming on that age where you're turning 73 or, you know, to kind of meet with the financial advisor and make sure that you kind of understand, you know, where you are, what tax bracket you're in, and how you can manage that. Okay, cool. Let's go to
charitable gift annuity.
Gift annuities. Yeah.
This does tie into the QCD because of this bottom line down here. You can actually take a one-time QCD of up to, I think it's $50,000 and do a charitable gift annuity. That's new. It came in, I think, last year. So it sort of ties us off of where QCD was and gets you to a different one. Let me explain what a QCD is. I'm sorry, a CGA, charitable, too many initials, a charitable gift annuity. We have a monopoly basically in the United States. The government, in its good wisdom, decided that they didn't want Laguna Canyon Foundation here in Laguna fighting against Nature Conservancy on a national basis for how much money they could give people. So they formed the American Council on Gift Annuities, and they said how much the rates are. So if you go to the Red Cross or you go to any organization that can issue a CGA, you're going to get the same rate. With the exception of Princeton and Yale, I think don't agree, and they give more money. So if you want to earn more, you might be able to go to them and get a little bit more, but then they get the money. So you give money to this nonprofit, and they have to be large enough to do a CGA. So, Red Cross, Nature Conservancy, whatever else. Or you can go through the community foundation, Orange County Community Foundation, if you're here, and say, I want to do a charitable gift annuity. And it's based on your age and how much money you're giving. It can be single or dual life. So for your couple, it can be for both of you. And there's a slightly different rate because they differ if you have 2 of you. It's a very simple form. It's 2 pages, no pressure. we talk a lot about Chapman University, David Moore, because they've sponsored us forever and they're delightful, fun people to do. And as David said, here's the form, read it, I'll explain it to you, and sign it when you want. There's no pressure because there's no benefit. There's benefit, he gets the money. The university gets the money. He's not on commission. It's not, it's not getting it. Because we say in a lot of the investment, avoid annuities, except a charitable gift annuity. So let's use an 80-year-old again, because I'm picking on my sister. An 80-year-old, if she put money in now, she would get 8.1% for the rest of her life. The amount is fixed at the time that you set it up, and it stays that forever. So inflation will be bad for this. If interest rates go up or down, you don't care. If the stock market goes up and down, you don't care. You're going to get 8%, 8.1% for the rest of your life. They have to, let's use Chapman as an example, they have to put money in reserve. They can't take your money and go have a good time with it right now. They can't give it away as scholarships. They have to go through and reserve the money. They have to assure that you're going to get the money back. They have to deal with, in California, the insurance commissioner, because that's who issues the license to be able to do a CGA. So you can't go to a small charity and say, here, you do one of these. They may have to get up to like a community foundation to be able to do it. And they have to set it up. Now, when you die, whatever's there goes to charity. Your family doesn't get it, your beneficiaries don't get it. That money is given to charity. You get a tax deduction for having done this. You can set these up as a testamentary trust. So when you die, you've funded a CGA, and that's money to your beneficiaries. You can set that up. That's not a problem. Again, highly appreciated assets, ones that don't get Berkshire Hathaway stock. This is a great way to get money out of it, because you can put your Berkshire Hathaway stock in here, pay no capital gains, and get 8% for the rest of your life.
So
And
Don,
yes,
sorry,
that's okay.
regarding these charitable gift annuities, you're going to go over what you get during your life, but just real quick, like regarding the testamentary one. So you can set these up for friends or like let's say long time, let's say gardener that's been working for you forever, like be a good gift to give to them when if you pass, and they get this, it's a small stream of income the rest of their lives. And
Right.
so it's a wonderful way to give, I think, to give a gift to not necessarily, your major remainder beneficiaries of your whole estate, but for specific people that were really important in your life. I think it's a wonderful gesture, and every, they would get a charitable gift annuity opened on based on their actuarial table,
Yep.
and they would get income for the rest of their lives. So every time
Correct.
they open
Correct.
that envelope, they'll think of you, right?
So as an example, it has come up in several of the live presentations. People on Zoom don't tend to ask the question, but in live presentations, Don, I need to talk to you. I've been living with this guy for the last 40 years, but we're not married. Okay, happy for you. But my family hates him. But I want him to be able to continue to live in the house that we've lived in all this time. But he has to pay rent. So I want to set up one of these as a testamentary gift annuity so that he will have money to live in the house for the rest of his life. And when he dies, the money goes to charity. And I'm guessing I've had this conversation 10 times with people.
Yeah.
And yes, exactly to your point, the gardener, the housekeeper, whoever it is. And generally the other part of that conversation is, I don't want my family to know. Well, they won't until you die.
Yeah.
And then they will. But they can't say, don't give anything to Bob because we hate Bob. Can't, you're dead. And they can yell and scream at you, but Bob's going to be able to live in the house and pay rent for it to stay there. And that's why they're setting them up. And it's an interesting one that's come up in several of the in-person sessions we do.
It's a way to get around. So there was Pete tells a story of the two ladies in St. Jude Memorial.
Yeah.
They met in a breast cancer group. They both had it. They both survived
Recovery
it.
group, yeah.
recovery. They became great friends over the rest of their lives.
Right.
And one left a charitable gift annuity to their friend because because she didn't like her husband.
Yes.
So
Yeah.
she didn't want to give her a lump sum because she
Right.
was fearful her husband would be. So instead, she just got a check every whatever it was.
Yeah.
And
Every quarter.
that
Yeah.
was her solution. And that's just again a wonderful way to do something like that.
It was fantastic giving it to somebody and saying, hey, here's what you can get and here's what's happening. So in
Yeah.
this example, I just, and again, the number is just the number. If you had $500,000, again, person's 80 years old, they get 8.1%. The parts that are important about this thing are there's the money you're putting in. That would produce a current tax deduction for you of $271,000.
And that's assuming like you're assuming a tax bracket, right? That you're kind of for the example for
Well,
American.
on how much that deduction is calculated through this, and we've said here's the tax rates and all the other things. The amount of the deduction is 200,000. How much you're going to save depends on what your tax rate is.
Got it.
So the 72,000 in here, I don't know because that depends on where you are. But remember when I said this 30,000 threshold over here? This just blew you through the 30,000. And now you have 6 years to use up this deduction if you had that money to give. Now, in this case, 80-year-old going to get 8%. So she would, in this case, get $40,500 for the rest of her life. Every month, every year, that's how much she would get. Generally, they're paid quarterly, so she'd get 10,000 a year. Over the time, she would probably get somewhere near what was originally put in. But the odd part of this thing is, because of the age, a lot of the money that's coming out is tax-free because it's a return on the money you put in, not on the income you're earning. So this 8% really earns 12% a year. First of all, where can you get guaranteed 8% for the rest of your life? Secondly, where can you get a guaranteed 12% effective tax rate? Because 29,000 of that 40 is tax-free. Okay, you can buy mutual, funds or something. I'm sorry, you can buy municipal bonds. Okay, they're tax-free, but you're gonna have to play with the rates and everything else. This is set for the rest of your life in terms of what's there. So it's a very effective tool if you have a nice asset you can put in. And again, it can be testamentary. You can do it after you pass away. Want to put your IRA in here? Fine, no problem. Put your IRA in here after you die. You can't do it today, but you can do it when you die.
Do you know how you would do that? I'm just curious as far like would you name let's say you have your beneficiary designation of your IRA. Would you put charitable gift annuity, or how
Well,
do
you would
do that?
you would go to Chapman and say, I'm doing this as a testamentary. Let's document it and have it all set up. So then it's there and available.
Work
Yeah.
with the charity.
Right. So then you've set it up so that they know it's coming. And then yes, that's the beneficiary, and that's where it's coming from. Yeah. Yeah.
Set it up with Chapman, name them the beneficiary, and then they'll set up. Yeah. Gotcha.
Right. Yeah. Yeah.
Okay.
So basically you're setting up a shell and you're then funding it with that. Now, having watched Leslie Duff do the presentation the other day, you might have to fund it with $1 now, $1, because in the state of California, you can't have a contract that's valid with nothing in it. So you fund it with $1. I don't know. Anyway, I'm not a lawyer. I'm an accountant. I just come up with these ideas and let somebody else work out the details. There's been a lot of conversation recently about a thing called the donor advised fund. A DAF, donor advised fund, DAF, is sort of like having a private foundation, except you don't have all the rules and regulations you have to follow. What this allows you to do is to put money in and then take the money out. We'll talk about bunching in a minute. Trevor mentioned bunching on the other side of having two RMDs in the same years. You may want to give a charitable deductions in 1 year where you put them together, but you don't want to pay it all out. As an example, we had set up a donor advised fund. And after our daughters took over the company, when COVID hit, they had very nice profits that had gone coming up to 2020 and wanted to give it to charity, but didn't know where to put it. So they put the money into a donor advised fund, into that fund. And then over the next year, gave virtually all of it out to food banks and different organizations that desperately needed the money during COVID, gave the money back out. But because they didn't know at the end of December who to give it to, they put it into a donor advised fund. It's tax deductible. You're giving it to a charity. A donor advised fund is a charity from that standpoint. Very simple to set up, either brokerage firm, community foundation, wherever you want to go. Opening it up is relatively inexpensive and tax deductible. The issue with them is it's a donor advised fund. You have given money to charity. You can't get it back. So I can't say, never mind. All the alcohol free. I want the money back. No, you can't. It is given to a charity and stays there. And you contact them and say, for instance, a couple of weeks ago, we were doing something and I wanted to give some money to a nonprofit that Gene was involved with. So in fact, there's online, went in and said, here's the charity, here's the tax ID, here's all the information. I want to give X amount of money. And they look to see it, that charity is in fact a valid 501c3. So you can't say, give it to Trevor because he's really nice and he needs charity. No, they won't give it to him because it has to be a 501c3. And again, whoever you want to give it to, political campaigns are not nonprofits. They are not something you could go through and give to. But that's where you can look at these things and say, here's what's going on with it. And they'll hold the money and be able to then give that out over time. What we have done was we've set up ours. We have this trust, a charitable remainder trust. When we pass away, all the money that's in it goes to charity. We've designated 4 or 5 charities that will get half of it. The other half goes into the donor advised fund, and our daughters will administer it. So now we're doing the philanthropic generational aspect that says, okay, we want you guys to do it. They're interesting now because they're coming back and saying, hey, you're getting a little old. Who do you want us to give the money to after you die? My answer is whoever you want. We're giving what we want to give. The others are your responsibility and your opportunity to deal with that. We're blessed from the standpoint they've got to their kids who are younger and said, who would you want to give money to? And so they're sort of looking at it downstream and saying, let's help them understand philanthropy, which is, we don't know how that wound up, but it's a lovely thing they have and a lovely gift, I guess, we've given our kids.
So to kind of
Sure.
break this down,
Please.
donor advised fund, when you make a donation to your own fund, it's essentially like gifting to a charity.
It is.
Yeah. But it doesn't go directly to any specific charity at that particular point.
Not yet.
You then you're the advisor basically of that fund, and
Yes.
you would say where and even when, whether it's this year or next year, that those donations or contributions to the charity
Right.
Would happen. And in the meantime, does the money just sit there in cash, or what does it do?
It's invested in a fund and it grows.
Okay,
I mean,
and who's in charge of that? Do you
in the case of somebody like Schwab, if you get up to a sufficient dollar amount, which we aren't, then you can start having specific advising you want to do. Otherwise, you're put into a pool of smaller DAFs. Now, when you put that into someone like Schwab, that's probably $1 billion in that fund, but they're all little. And then they'll have other investment vehicles if you got bigger. If Gene and I both died and half of what's left in the trust goes into it, they'd have the ability to specify how they wanted to invest it. Today, it's just invested, but it's growing. I mean, we look at how the other day our kids went, how much is in it? Such and such. We haven't put that much in. It grew. And you're not, there's no tax on it. It's simply you're growing the fund because it's parked here. In a foundation, you have to give 5% a year away, minimum 5% on anyone. Whether that's the Gates Foundation, whether that's the Ford Foundation, whether it's anybody's private foundation, they're very strict and a lot of rules. They haven't restricted that yet on a DAF. There's talk of doing it. And incidentally, your qualified charitable distribution, the QCD, you cannot put into a DAF. They haven't allowed it. And I'm guessing they probably won't, because that's too easy. Because then they can just say, oh, I don't have to think, just park it over there. In our case, especially the money our kids have put in, they're churning it through. And so they're spending the money as they go, which is lovely. Yeah.
No, it's a wonderful way to do it, and also kind of have control of your giving and your tax planning.
Yep. We talked about this again last week in terms of the IRA, what happens to it. With the Secure Act, they changed. It used to be when I passed away and I gave the money to my kids, my kids would be able to take it out whenever they wanted over their lifetime, whatever. They came back now and said, with certain exceptions like spouses and others, if you get the money, they have to take it out within 10 years. Now, they can take it out on day one, they can take it out on day 10 year out, or they can take it along the way. But they have to have it all out in 10 years. They said something back then a couple of years ago, and they confirmed it during the summer. In my case, I now have to take out an RMD. If my children inherited my IRA, they would have to take out an RMD based on their age, not mine. But if you've been taking an RMD, then the fund that goes to whoever your beneficiaries are will have to pay an RMD also, based on their age, not on yours. So I could say all of it now, all of it later, nothing in between, except for the RMD part of that. When the money comes out, it's going to be taxed. Remember, it's income in respect of decedent. It's going to be fully taxable as ordinary income to whoever inherits it. And we joke at times that all the wealthy kids in Newport Beach or wherever you might be, on their speed dial on their phone is the Maserati dealer or the Porsche dealer or something else. And I say that to people in one of the in-person sessions we did. It's a lady that saw me afterwards and said, when my mother passed away, my father inherited her IRA, and he immediately cashed it out and bought a Porsche because she wouldn't let him have a Porsche, and he wanted the Porsche. So he cashed it out, not knowing he had to pay tax. Then the next year he got hit with the tax on the cost of the Porsche. So it's an interesting one to look at, one that you get a little scared with. If the money's given to charity, they're not taxed. It's a bit of a handle for them to deal with, but they don't actually have to pay any tax on that money. So they get the whole amount. So if you're looking at your kids and saying, I don't know that I want to give all this money to them now, you can set up a testamentary trust. It's not limited to the 10 years. It can be for their lifetime. It can be for some other time that they want to set it up with, but they can go through and do it. So as an example, here's a testamentary trust, $500,000. The kid today gets nothing. They're 45 years old. The estate will get a deduction, whether it's needed or not, that's fine. The 5% is going to produce an income for them as they go along. And the estimate at a 45-year-old is they're going to get $1.3 million out of this thing over those years, because this is going to grow. If it's paying 5%, we assume the stock market will be bigger, so it will grow over time. So the first year they may get 25,000 and grumble at you. The next, as it goes on, it will get more and more, up to the point where they're estimating over all those years, because it's a 45-year-old, they'll probably say it's going to be 50 years that they're going to get money. And that stays there. It isn't limited to the 10 years. So you can set these up. It could be a charitable gift annuity instead. It could be a testamentary trust, whatever. And it isn't limited to 5%. That's just a number I use as an example. So let me give you a picture of why some of this matters. Hypothetical. Whether the numbers make sense or not, they're good for purposes. Your estate's worth $2.5 million. Your IRA is $1.5 million, because we said these things are getting so big, they're bigger than the house. And the house is $1 million. So what happens? Well, the kids immediately say, we want the $1.5 million. Give us the IRA. We'll take the $1.5 million. That means they'll probably pay upwards to $550,000 in federal tax. California, they're going to be in the upper limit. They're going to pay $190,000 there, almost $200,000. The kids are going to net $750,000 out of that $1.5 million. The charity is going to get the $1 million house. Okay. If, however, you turn it around, give the charity $1.5 million, they're going to like you even more because you gave them an extra $500,000. The kids get the house because with step-up basis on the estate, that house will now be sold for no tax. So they could sell the house without any capital gains tax after you die for $1 million. They just made $250,000 more by getting less. But that's where the tax hits you in terms of what that does. That's based on the step-up basis in taxes. We won't talk about Prop 19 in California and property tax and things, because that's assuming they're going to sell the property. Okay, so a charitable gift annuity, very simple, as opposed to a remainder trust, which we'll talk about in a couple minutes. Charitable gift annuity, it's fixed amount based on your age, fixed based on the dollar amount you put in, doesn't fluctuate, it doesn't change. Single life, dual life, you and your spouse, however you want to handle it. The charity assures that it's the payment for life. Simple 2-page form. It is irrevocable, so once you've done it, you're not going to be able to take it back. But it's not like the 27 pages that they have for brokerage firms or something with all kinds of index fund annuities they do and all the fees that you're paying for that. This money all goes in, and that's exactly what you're going to get. Charitable remainder trust is much more flexible, allows you a lot of different things to be able to do. You have to take out at least 5%. That's the minimum amount. The rest of it is based on your age and other factors, and the system, which we'll show examples of, calculate how much you can actually take out. It's either a fixed amount that you take out for a fixed percentage, or you get annuity based on or fixed base. We'll talk about all of those. You can do it for your lifetime. You can do it for a number of years, or you can do it for your lifetime and a number of years. They can run out of money in theory because you've absorbed all of it down. That could happen. You certainly needed a lawyer to do this. It's a complicated system, and there's reporting and other things with it. We talk about Pete. Pete set up a trust when he was at Long Beach last century, which he really enjoys my saying to him. Last century, he set up this trust for one of the instructors. And he and his wife lived X number of years. And then they had put in that their beneficiaries got money for this period of time afterwards. And I think it was 2 years ago. So 20 plus years after it was set up between their lives and the beneficiaries, it finally paid out to the beneficiaries. But for, I don't know, 15 years at least, that paid out to the beneficiaries after they died. And then it was distributed. Pete had set it up, and Laguna Canyon Foundation, which Pete and I have been involved with, was the administrator for it. And at the end of it, we distributed money out. And most of the money, because of what it had earned, it paid out almost as much as went into it. So that's certainly one that the beneficiaries got paid. Let's talk about remainder trust.
Hang on, before you go on, there were questions regarding DAFs, so we don't want to get too far ahead. Both questions are like, they were a little unclear about the benefits of DAFs versus just giving direct to the charity. Can you summarize the difference between the two?
Two things. If you had, let's say for the sake of discussion, you got a bonus, or you sold a stock into something else, because you can put appreciated assets into this. You can put a stock into it. It can hold the money. Maybe you have something that you want to put money into a charity cause to get the tax deduction or some other reason, but you don't know where you want it to go. Again, I go back to our daughters. They had a certain amount of money at the end of the year. They wanted to give it to charity, but didn't know yet who to give it to. If you bunch, as you talked before, where maybe 1 year you give more money into it than you would want to give away, but you don't want to give it to the charity now, you want to give it to them over time. Then you can set up the donor advised. And incidentally, you can set them up, because I noticed this the other day when I was doing it on Schwab happens to handle our DAF. You can set it up as a recurring payment. So if you say, I want the church to give money, they may not say weekly, it may be monthly or quarterly, but you can set up a recurring one. So you've put money into that as a block, put in the stock, they sell the stock, here's a block of money. And they're holding that now for you, rather than saying, well, gee, I want to give so much to this group or this group. It can hold the money for you as a charity and let you have the tax deduction.
There's more flexibility, sounds like, in your giving, but you still get the same tax deductions and other benefits as directly. Now, I guess if you know exactly who it's going to,
give it to them.
Give it to them. And that's fine. But having a donor advised fund seems like a nice way to park your charitable funds while you do your homework and research as to who you're going to give them to. So,
and you phase it out to them. In the case of my sister, there were two charities. One was based on her husband's wishes, and ones were based on hers. And I said, do it now. And so she gave the money now to them. She could have put it into a DAF.
Yeah. Okay.
But the point was to give it to them and let them use it. But that's a different situation. So that's
right.
Yeah.
Okay. Let's get to the trust, because I want to make sure we have enough time for those.
Trust. Good for trust. Okay. So again, you'd rather put in significant assets. I keep picking on Berkshire Hathaway. You have that. Or in my case, it was a building. We had a building that had a very low basis, 20 years later, after we sold that one, bought another one, happened to have bought a very nice location and size of the asset, it grew very nicely for us. You don't have to put it all in. Pete was real quick with this of, here's how much it is, but Don, you can take a bunch of it out. I'll show you an example that you can take it out and then wind up netting no tax. If you want the money now, it's called the Charitable Remainder Trust, and we get paid every quarter. We get amount of money. We'll talk about how that's calculated. If it's Charitable Lead Trust, and if you think of someone who I went to work for, if you went to work for Google or Amazon or I don't know, whoever, some high growth company, as a beginning person, you put your stock into that, you pay charity now, and then when you die, the money goes to your heirs, or X number of years out, goes to your heirs with a tax advantage. But it's got to be a really big advantage, and you've got to be able to pay the charity now. And that's what's important in this one. So there aren't as many lead trusts. They tend to be more of a remainder trust. A charitable remainder uni trust, which is ours, a CRUT, is a fixed percentage. I can't change the percentage, but every year, December 31, we value what it's worth, sort of like the RMD is, and we get X% of that over the next year on a quarterly basis. Honestly, I don't care what the stock market does during the year. I care what it is on December 31 because it tells me how much money I'm going to have for next year. A CRAT, a charitable remainder annuity trust, says, pay this much money for the rest of my life. And that's fine unless it runs out of money. Charitable gift annuity doesn't run out of money. A CRAT can run out of money. And that's why it's be really tricky as to why you'd want to do one versus the other in that case. You specify the charity or charities that you want to receive the money when you die. When you die, it all goes to charity. It's gone. But you can change it. We've changed ours over the years and said, oh, we have some disagreements with that charity, took them out and put other charities in. Once you die, that's locked. And other than in our case, the donor advised gets this much. That could be the girls can do whatever they want. But we're specifying this percentage goes to each of these charities. Again, lifetime plus years, whichever you want, and an attorney's drafting it. So let's look at a couple of examples. So I have an asset, it's $500,000, it's a low basis, so capital gains. So I would wind up paying capital gains tax if I sold it. But if I gave that $500,000 asset, I'm going to get a $230,000 tax deduction. Use it now or over the next 5 years. In this case, I set it up at this age. I just specified 7.5%. It tells me whether I can do that or not. And I said, that's how much I want to take out of this. So effectively, again, because of return on investment, I'd be earning 8%. Now this fluctuates on how much based on what's in the balance at year end. This is taking cash out. You can take out roughly a third, let's say, 30% of the money. And by taking it out, you'll pay capital gains on this portion, but you get a tax deduction for the other, and they should offset each other. In the calculations, I can say, make this zero, and it will go through and tell me, so this $1 million asset, I could have taken out almost 300,000 and net over time, been able to make that come to zero. So that's an option also. Couple of examples. This one's going through and saying 5%. That's how much the deduction is. It's lower than you saw a moment ago because it's lifetime plus 10 years. So I can give this to my beneficiaries, whoever I want those to be. I can give the money to them for 10 years. The income I was receiving goes that time. By having it be 5%, it will probably grow in value over the time. And that's what you're going to wind up having. So they're estimating you take out 700,000 because you have lifetime for you is at 80 years old, it's going to be roughly 95 as your age, but then they add 10 more years to it. That's how it goes out. So in your lifetime, single or dual, and plus 10 years. Same idea, except in this case, I made it 7.5% instead of 5%. What's the difference? The difference is you're now taking money earlier. You get less of a deduction because you're taking money earlier. That's different than it was before. Now you're taking out 780,000 as opposed to 705. So while it went up 50%, 5 to 7.5, it didn't go up that much from the 5%, but you're getting more money now, less money later. And that's where the numbers all work out. System all produces all these examples for you.
So this is called an illustration.
Yes.
this is the numbers, you input the numbers,
Yep.
but it comes out, this is software, right? You didn't do this with your calculator and
I did not draw these pictures with my
okay, yeah,
crayons. No, I
okay.
did not.
So
And type on them. No.
yeah, so every plan giving officer or plan giving office would have similar software, if not this specific called Crescendo software.
Right.
So one of the things I've noticed is so when you're making when you're constructing this with your legal counsel or your CPA, your financial advisor, you got advisors around you, when you're setting your rate, you're really saying, one of the, you got to figure out what your goals are. It seems like if you want a higher rate, you're going to be drawing more now, but it could in the future, let's say if you live another 15 years, that might go lower because you're always basing it on the 12/31 rate, right?
Right.
So
Right.
if it doesn't grow, let's say it grows at 7.5% average. Well, you'd kind of be, equal
Floating.
on,
Yeah.
yeah, but on the 5%, and therefore at the end of it, there's less going to charity because you're pulled out more during your lifetime. But if you do 5%, it seems like, yeah, you may get less now, but there's a chance because you're actually growing the trust in the
Yes.
future, you may actually end up getting more money than you would if you had 7.5% if you lived long enough.
So let's go back up to the, like the third slide or something. That what are we trying to solve?
Yeah.
And if what I'm trying to solve is, I think I'm going to need more money later. Let's use an example. I don't have really good long-term care insurance. If that was my problem, I want more money later because I'm going to need more money later, assuming I live that long. I'm going to need more money. If I have that taken care of, we looked at it and said, we were taking out more than it's earning. And I look at this and say, it is a charitable remainder trust in my mind. It's not a charitable growth trust. Crescendo, the software that does this, the gentleman that founded the company, I went through and got certified on how to use all this stuff. He argued vehemently with me. You can only take out 5%. And I said, Charles, you have to take out a minimum of 5, but you can take out more. No, that's not fair to the charity. And I said, Charles, it's a remainder trust. Live with it. They're going to get a nice sum of money. So we know that every year ours will probably go down. Now, there have been years it's actually gone up because the market's gone up so much.
Right.
Yeah. There are years it's gone down and we've got, oh, yeah, we're going a little bit less next year, but it's still a very comfortable level for us. And again, we're not traveling the way we did before.
And what happens if you put in like, oh, I want a 40% payout? What does the software do?
No. So in our case, I went through and said to somewhat your point, what's the answer? So I said, I want 15%. Thinking, no. And it came back and said, no, that's too much. But you can go to this level. We didn't go to the highest level. We could have gone higher. But I said, no, from a planning standpoint. We redid my parents' house years ago, and the architect we'd known since I was a child. And I was describing this to him. He said, no, wait. So if I put one of my buildings in here and I set this up, can I take it back out in 2 years? So can I have, an 80% payout rate? No, you can't. That's not why it's here. Oh,
So there's restrictions.
Yes.
That
yes.
in the soft, it's not so much software restrictions. It's more like
regulatory.
Regulatory, yeah.
And then the software drives that and says, what interest rate do you want to use? What do you think you're going to? Well, interest rate. There are factors the government has that. Here's the current cost of funds, if you will. But you can say, I think it's going to earn 7% on the stock market, and I want to take out 10%. What's going to reduce? Be statistically, because if I take out 5, but I think it's going to be 7, it's going to grow, to Trevor's point a moment ago, and that's great, and that's where you come out of it. But that's where you look at some of these things and say, those are the things. Running the numbers does this, and this is what I do with people, and just say, let me run it. And I've had people talking to their alma mater. There's a guy from Princeton. Wanted to really go through this thing. Princeton wanted to set up a charitable remainder trust, and here's what you need to do. And he went, I think I need to know what I want to do, before they tell me what I need to do, and then we can negotiate. So he had run numbers over here, and they're saying do this. He's going, this is what I want. Oh, okay.
Yeah. Yeah.
And
No, you need to do a
yeah.
lot of planning. Okay, let's get
So
going.
let's look at this. So we're almost to the end at this point anyway, but there are different kinds of remainder trusts. A standard trust is Berkshire Hathaway stock. I put it in, it's immediately sold, and you immediately start getting money. A night trust says, I only want income. This would be if I'm 50 years old. I just got my stock bonus. I put it in here. I don't want the money now. I want it to wait until I'm older. So when I'm 65 and retire, I want the money. A NIMCRUT says that I want to do that, except when I hit 65, give me all the money I didn't get. That's kind of cruel. We had a flip trust, which said, I'm putting in an office building, which now has to be sold. And you can't sell it first and then put it in. No, we had to put it in and then put it up for sale. Now, we had the contract waiting to be signed for the building, but we had to put it in and be officially in before we could sell the building. We then didn't get we got the money from the rental income until it sold. And then the next year we flipped into our normal payments. But you get the tax deduction on any of these now. This sort of follows the example we had before. If you had that $1 million asset, here's what you're going to have. After taxes, you'd probably net, let's say, $640,000. If you put that $640,000 into a charitable gift annuity, 80 years old, remember my 8.1% person, realistically, I'm going to say it's a 35% tax rate. You're going to get an annual payout out of that of $51,000. If you gave the $1 million to charity instead of selling it first, you're going to get a much higher tax deduction. Instead of $78,000, you're going to get $220,000. So you're going to get immediate tax savings of another $144,000. But more importantly, your 8.1 is going to give you $81,000. That's $30,000 more than you would have gotten before. And you get that for life. And that's just the difference of who got the money first. Did you sell it and give it, or did you give it and they sell it? And that's the way you really want to go. We talked about this before. What are all these issues? Run the numbers and see what's going on with it. And to Trevor's point a moment ago, this is the screen that you go through if you're working with Crescendo. These are all the options that software sets up, except with any one of these given options. So if I come down here, for instance, to a uni trust with a flip, there may be 20 different options underneath that one line, but these are all the things that they've set up to be able to go work with. It's a lot of stuff. I put these in just because they're there. I was interested a while back in saying, how do you have a conversation with people about these things? And again, if you go to the IYME, if you go to the website and you look at, where Eugene showed you originally, here's where all of the handouts for today. Above that, there was a thing on booklets. And these are 3 booklets that I wrote a while back, and they're conversations in terms of what you can do or where you can go with it. That's the end I've got. Thank you very much. I will stop sharing, which I can do up here. There you go.
Okay. One of the things regarding the charitable trust, remainder trusts, the money or the assets inside that trust.
Yes.
Did they grow tax free while they're inside the trust?
Yeah. So in our case, we sold the building and the money was invested. And during the year, it's invested and you go through. Now, you have reporting requirements with the charitable remainder trust. Your individual, your revocable trust, living trust, is simply you in the form of a contract. So you don't have to do extra reporting. You have other reporting to do in this case. So I may pay income taxes. It's called four-tier accounting. They come back and say, this is how much is ordinary income. This is tax-free. And remember that capital gain that I didn't pay? I pay that every year through the rest of my lifetime. So that's a tax that I have to pay. A portion of my capital gain I have to pay against every year. But it wasn't what was back there. And the money that I didn't have to pay has been invested this whole time.
Yeah.
Yeah.
Okay. Question about IRAs. and
Yes.
401k. So let's say you have a 401k and not an IRA. Do you take required minimum distributions as well? And I think the answer to that is yes. However, you cannot take advantage of certain
QCD.
things like the qualified charitable distribution unless
Right.
you roll that over into an IRA.
That's
Yeah.
my understanding also. Yes.
Yeah, yeah. Cool. All right. Eugene, are you there?
Yes, sir. I'm here.
Okay.
Well, I tried to get you close to the 11:30 time.
Yeah, that's good timing. Okay, well, I'm gonna close it up just for now. Let's stick around for those that want to do the live Q&A session.
Mhm.
But for now, thank you so much, everybody. Trevor, Don, appreciate your time. And everyone else, have a good day.